Good morning, gentlemen.
Good morning.
Morning.
Thanks for joining me today. So before I even get started with the introductions, I'm just going to say this to both of you guys right now. It has been so much fun for me the last two times in preparing for today, getting to know you guys and kind of leaning into this and just kind of learning. So with that said, let's get this thing kicked off. So everyone, we are joined today by Dustin Brohm, host of Massive Agent Podcast for Realtors. Welcome, Dustin. Thank you for being here today.
Thank you, Ernie, for having me. Appreciate it.
You bet. And by the way, I met Dustin. I was at a dinner. There was you came to town, you live in Utah, you came to Denver. We were at a customer dinner and we were sitting next to each other. And then I think out of that, it was like going, well, that guy's pretty interesting. Maybe we should invite Dustin to join us.
And look at us now, Ernie.
And look at us now. What I love is that we've done a 3-part series. We haven't had any agent representation for the first 2 pieces. So I'm so happy to have you here today, Dustin. Thank you. We've also got Joel Kahn here. So Joel, welcome. Joel is the VP Chief Economist at the MBA. I didn't meet Joel, but I became a fanboy of Joel in September when I was at the Digital Mortgage Conference in the audience watching his presentation and watching everybody take pictures of all his screens. Joel, welcome today. Thank you so much for joining us. It's really an honor to have you on.
No, thanks for having me. I appreciate it. This is something I've been looking forward to. It should be fun. Hope we get to all we wanted to talk about.
Yeah, a lot of cool stuff here. So we're going to start digging in. And so just kind of set this up for folks that haven't seen the previous 2 versions of this series. We've been digging in to other subject matter, and it's really been sort of lender oriented. So lender vendors, actually loan officers themselves that have been giving us a lot of great insights about things that are happening in industry. What we're going to do today is that we're going to connect the dots between market trends, how to generate agent referrals, and how the smartest pros are already preparing for 2026. So the one thing that I'd love all of our listeners to really lean into today is that, having Joel here, you've got Joel, who's the economist, and you've got this microeconomic landscape that he's going to really spell out. And so we're going to pull threads of that and sort of intersect. And what does that mean to us as lenders today? And then with Dustin brings the ultimate perspective of an agent. And we're going to ask the agent to respond to Joel's stuff today, but also we're going to pull that thread with Dustin to say, how does Dustin's reaction to the economy or lack of reaction, how does his reaction or his perspective on this as proxy for real estate agents, how does that affect us in terms of how, as a lender, and I'm pointing myself as a lender here because I feel like I'm proxy for the lender community today, of how should Joel be affecting the lender community? So with all that said, let's start with the 5 big forces that have been shaping 2026 and the previous. So the first version of the series, we talked about trigger leads, trigger lead ban. What does that mean to lenders and all of this stuff? Obviously, declining mortgage rates has been the topic du jour for it's always the topic du jour, mortgage rates are. And affordability innovation. So I think the last webinar we did, we leaned into the innovation around what's happening with assumables, rate buy downs and that stuff. And then we're also have talked about tappable home equity and the surge on that. So, these are all things that we've been talking about as a lender community and with this series. And so I guess what I'd like to do is just kind of, get Dustin's reaction to these things that are so important to lenders and the community. I'd like to know, what does it mean to you, Dustin?
So I'm a Cliff's Notes guy. I know lenders like to follow the interest rates, like every little bump throughout the day. And I know that that's important for locks and floats. For agents, just tell us what direction things are going. And so I'm interested to learn from Joel today on what we can expect next year, because even though I don't nerd out over the small details, I'm a marketing guy. That helps me with marketing, speaking to consumers, if I know what they can expect. If we have a general idea of what next year's going to look like, we can give better advice to our buyers and sellers, and we can do better content and position ourselves as more of an advisor who can be trusted, if we're actually up to date on certain data points. But that's how I look at it. Like it's all interesting, but I kind of zoom out and I'm just like, okay, like what's the general trend here? What do I need to know? Give me some bullet points. I'm certainly not following the fluctuations of the 10-year on a daily basis. I'll let you guys do that and then just, give me an update later.
So hearing you respond to that, it's always interesting because it's like lenders, we get really, the lending industry gets really focused on this stuff. And now here you are, proxy for like an amazing community of real estate agents, and you being their fearless leader, you saying, it doesn't really mean so much to me. I'm more focused on more the organic relationship building side of that. So anyway, we'll stop right there. I think that's fascinating. And I think that's something that we're going to hear more of as we go through this. Now, on the other side of it, macro really does, macro is affecting, most macro affects the home equity, macro affects the declining, this kind of stuff. Joel, do you have a reaction to this slide, to these ideas around what the lending community is getting focused on, and how do you think about how what you do in this industry affects lenders in that way?
Yeah, absolutely. I think to your point, the macro certainly matters because it sort of gives us a structure, right, for how the housing market might be working one way or the other. And, for example, if we look at what our expectations are for 26, we have a slightly weaker economy or slower economy in 26 expected relative to 25. We do have the unemployment rate, or we expect the unemployment rate to actually come up a little bit, meaning things are a little bit weaker. So naturally, that does mean a little bit less housing demand. But at the same time, I think going back to bridging the macro to the micro, or even macro to the local, and what Dustin was getting to as well, is things are really different depending on where you are in the country. So local housing markets really ultimately depend on the macro, but then also have their own, I guess, their own way of impacting borrowers, right? I mean, vice versa, right? So whether it's supply and demand of the homes for sale, all that stuff that is so different at the local, at the state level. So the macro piece, again, it does matter, right? Obviously, it impacts rates, right? It impacts just sort of broader job market health, how consumers are behaving, et cetera. But then when you drill down into like local markets, metros, cities, all that, things really get very specific.
Yeah, not to overgeneralize, Dustin, but it's interesting. So, Joel's coming out with a macro. Obviously, there's a macro story here, and you don't really care about that. You care about your micro story because you're in market. I came at you with these 5 forces shaping the lending industry in 2026, and you're like, no, I don't really care too much about that either. I care about being a wealth advisor and to being someone trusted. Do you even look at social media, Dustin? Are you affected by that, or are you just dialed into being a great advisor for your customers?
Do I even look at social media? My goodness. Yeah, way too much. Way too much.
I'm just saying, letting out these outside forces sort of affects your stuff. But we'll pull on that some more. Let's move on to the next slide here. So Joel, take it away. What are we looking at right here? What can we expect going forward? What does all this mean?
So what we're showing here really is our projections for the next few years, and we're looking at about an 8% increase in purchase. I'm sorry, in just overall origination units in 26. And so if you break it out by purchase and refi, you probably have a little bit more purchase, a little bit less refis than we're expecting previously. But I think really the two things. So one is growth in 26 is good, right? We've gone through 2023 and 24 pretty rough years for the industry. And I'm sure even for the real estate folks too. And we are expecting some growth in 26, 27, especially on the purchase side. So I think that's one big takeaway from this. The other is maybe the more sobering piece is that even with that growth that we're seeing, it's still going to be pretty challenging for lenders relative to where we were, just a few years ago. So I think it's a bit of both, unfortunately, right? It's a bit of good, it's a bit of bad, but yet still want to make sure that we touch on some of the positives, that there are opportunities out there and that we are expecting this growth. And like I said earlier, it also, or it does really depend on where you are in terms of, how much, growth potential, I guess, you might see.
So the first thing that kind of strikes me though is that I just saw you on stage September 17th, which is just less than 90 days ago. And you had a different number on the screen. And I know you, because I already used that in some of my LinkedIn posts. I think it was 11% increase on, I think it was unit volume increase in 2026. Do I remember that correctly?
Yeah, you did. And a lot of that downward revision really was on the refi side. So
Oh,
still pretty bullish on refis in the sense that even with rates in the 6 to 6.5% range, refis do matter for some homeowners out there, and it can be beneficial. But and we did see some pretty, I would say, pretty sort of reactive periods, over the last 3 months or so. But just thinking about where things might go next year, we toned that down a little bit. Again, the opportunities I think will still come up because rates have been volatile. You have seen rates move up and down,
right.
or down in some weeks. So it did have to kind of trim that a little bit. But I would say that our purchase forecast has been pretty stable as far as comparing the September version versus the November version.
So I get that. So basically the change, because 11 to 8 is not insignificant. But so refi took a whack, right?
Yeah.
I think in general, though, I'm going to push this back to you, Dustin. What does this conversation mean to you as an agent?
So I look at it as ammunition to use in content and marketing to get ahead of next year, to educate and advise people on what they want to do. So like for sellers, for example, if we know that home prices are going to go up 8%, sorry, not home prices, but the number of homes sold is going to go up 8%. Like, what does that mean to those clients of yours that want to sell their house in the summer? Should they do it sooner? Should they do it later? Like, give them some context. When you have accurate data, and you can give better advice. Like, you can prescribe a solution to somebody rather than just like, well, I don't really know if the market's going to go up or down or what that means to a buyer, a seller, or an investor. So that's why this data is important to me. But I see it, my brain always goes to content. It always goes to content. It's a blessing and a curse. But I see this and I'm like, well, what an opportunity now to have this data and get ahead of, January, February, March, right before spring market. Start educating people now so they can start making plans now and position you as an advisor in their eyes now. So once they do start preparing their house for sale, for example, you're the first person that they think of. So yes, this is not insignificant data. I'm like, okay, 8% more homes going to be sold next year. What does that mean? Let's go tell the people.
Yeah. I hear that theme again too, where you're pulling two things. So you're pulling the macro of this, that's valuable. You're pulling it to the micro. So you're filtering it down to what does it mean for your particular market, where I think that there's probably some depth skills to be had there, whether it's you working with a lender, working with an economist, working with the data to be able to create that content so that you're creating meaningful content and meaningful message in your market. But it's the second part that I keep hearing you say over and over, which I'm hearing you say, but it's a means to an end. And the end is that you're building relationships and you're building trust for those folks to help them make decisions, help your clients make decisions in 2026.
Yes. And let me add one extra part, Ernie. I see this all the time. It's like this epidemic amongst real estate professionals is we get this data and then we just go spit it out on social using all the industry jargon that literally no one that we want to watch our stuff understands. And we just talk over their head. And when you talk about BIPs and you talk about FHFA and Fed funds rate and all this stuff, Holly homeowner doesn't know what the hell that means. She's like, what does it mean to me? So it's important that you take this and you're able to communicate it in a way that actually speaks to people and not over their heads. That's important. No industry jargon when you're talking to consumers, because if they understood all that stuff, well, they wouldn't need you now, would they?
That's a great point. And the way I think about it, if I were a lender and I wanted you to send me referrals, I would think about, well, how do I help your business? How do I listen to what you're saying right now? How do I approach you and say, hey, I've got data. I'd love to work with you to be able to map that data into the clients that you serve so that you can get ahead of that, so you can position yourself as an advisor. And I think that's a really important takeaway. Again, the book's going to stop with you on this, Dustin, because I think that we're really orienting this conversation today around what's all this lender stuff mean to real estate agents, and how does that help us partner with you in productive ways. So let's keep this thing going. Next slide. Joel, take us through this. What's going on here?
All right, there's a lot here. I'm going to try to keep it short, but feel free to jump in. So I think two things, well, two charts, obviously, actually more like four. I think I try to overachieve here. On the left, just thinking about the home equity situation for the US. So really, if you look at the panel on the left, the chart on the right, that shows home equity wealth. Okay. And so what that's showing is that we've done pretty well since the last time home prices were down. So that was following the last great recession or the great financial crisis, depending on who you want to talk about or how you want to talk about it. But, but since then, we've gained a significant amount of housing wealth. And so between rates being low and people able to pay down, more of their mortgage and more of their principal, and home prices increasing, we've gained a tremendous amount of equity wealth. And this is important to show because I think it gives you, I guess, more support for, just the justification for, behind why home ownership, right? I mean, I think that's been in question in recent years, given that it's been more expensive to buy and to maintain a home. But at the end of the day, if you look at it as sort of on a longer term horizon, I mean, that's done pretty well for people who have already bought, right? And so I think that's something to focus on, and also the opportunities for someone who has or is currently owning and is looking to sell. They do have that equity that they can utilize if they want to move. So that's one, and I think that's been certainly something that we've seen helping and supporting a lot of the sales transactions that we've seen. The chart on the right is related to that because it's our projections for home sales. So the bars on that chart on the right panel just show our expectations for what home sales are going to do. And in short, we do expect an increase in home sales over the next few years. So I think that the natural question that we get is, well, why? Like, if you say the economy is going to be a little bit weaker, the unemployment rate's coming up, rates are still at 6 to 6.5%, who's buying and how are they buying? And I think the biggest thing there is that even with a slightly slower economy, it's not all bad. This is slower than we were last year. We're not talking about a recession, right? You're still seeing some growth. And the 6 to 6.5% rate really isn't bad, or isn't that high if you go back further than some of those 4% years that we got recently. And then maybe one of the bigger things is inventory. So for a long time, we talked about just people having, no options, inventory so low, you can't find a house that you want to buy. But now that we've seen the inventory come up, we've actually seen home sales and just purchase activity come back again, because now even with rates in the 6% range, buyers have a choice, right? Like, they're not just stuck with one or two options. They now have more options if they want to get into ownership or if they want to move. So that in essence, kind of feeds into why we think the purchase originations numbers are going to come up, because, with inventory growth, with home sales and just home equity wealth to tap, we do see some drivers to growth. So I'm going to stop there and then
That's super
get your reaction.
I'm going to start with the first one. I'm going to push that to Dustin. So Dustin, so this is a big story in lending, doing either HELOCs or cash out refis. And it's obviously cash out refis get a lot better as rates start coming down. But all this equity, people can, when there's not enough inventory, they can do improvements. But I'm saying it's a very big story, home equity and home equity unlock. What's that mean to you from an agent perspective?
I'm okay. I gotta be diplomatic about this. It obviously, what I don't want you to think is that it just doesn't matter to agents, because it does. Right. It's important. It's an important data point, because a property owner has options, the more equity they have, right? They have more flexibility and more options on what they can do. And so I believe agents should see themselves as advisors and not salespeople. I can't remember the last time that I had to like talk someone into buying a house. So like, we're not salespeople. So when I was looking at the chart on the left there, my oversimplified version of it, I'm like, well, it looks like equity is rising a lot faster at a much steeper rate than debt. That seems positive to me. And so I would probably take that concept, dive into it a little bit more, and like, how can I communicate that to give more ammo and give more options to a homeowner who maybe there's so many homeowners that are just sitting there thinking we're stuck in this house because we cannot afford going anywhere else. And if you show them that there are different options available because they're sitting on a bunch of equity, that then gives them tools and options to do A, B, or C, or D that maybe they didn't even know existed. Like,
Right.
that makes you extremely valuable to them. Every real estate professional that I've talked to, when you ask them, why do you do what you do, or why did you get into this industry? They all at some point, a lot of it disingenuous, say, well, I just want to help people. Now, I believe that we all do want to help people at a certain point. If that's really something that fuels you, this is an incredible way, by knowing some of this data, that equity is rising fast. People are sitting on equity, which unlocks other options that they probably don't know exist. What a great way to make an impact on them and their family. Because where you live, like, I can't think of anything more impactful on a family than where they live. It affects every aspect of their life. So that's how I look at it.
So based on what you just said, if I were a lender, here's how I would approach you. And I'm curious what your reaction is. So as it relates to the subject matter of equity growth, I would say, Dustin, equity growth is great, but you probably have a lot of clients that ultimately can't even afford the house that they're in, because as the equity goes up, the value goes up, their property taxes goes up. So,
And insurance.
And getting ahead of that, I think it's going to be important to advise your clients who are equity rich about the possibility that they might want to take the chips off the table at some point, and to actually sell and move to somewhere that's less expensive, and put that cash in the bond market or something, right? But in being anticipatory and really thinking ahead, is instead of just high-fiving, oh, your home value went up, say, okay, now you got to do great planning. This is where wealth advising. And so I can help you do that. I can help you understand. I can help your clients understand how to do that. So that would be sort of one angle on that. I'm curious to get just your reaction on sort of your reaction to that. Is that something that you, as an agent, are you actually going to care about getting in front with your clients with that sort of narrative and that sort of story?
Yeah. Agents should. So often lenders will try to build a relationship with an agent in all the wrong ways. Like they try to, it's like, hey, I'll take you golfing, or I'll take you to lunch, or check out these flyers that my company made. There's such nice flyers. And that's how most lenders approach it. And they go to agents and they're just like, please send me business because we have great flyers. I'm paraphrasing, but like, I've seen a couple of these presentations from lenders. Not awesome. But if you as a lender can show that you can advise and give options to our clients and agents' clients, that, like, I now see you as a potential partner, as a potential teammate who I'd want in the conversation, to help that person as a team. Like, right. That's an incredible thing. And I think most agents, it's unfortunate. Most agents are, I don't want to say that they are intentionally transactional minded. I think it just happens because they're so laser focused on just doing their thing. Mm-hmm. But they don't take a step back and they're like, well, it would be really awesome for the Jones family, who we just sold them a house 2 years ago. And I know that they're worried about losing their job because their company's doing layoffs. Well, what if they took advantage of a HELOC, got that locked in now, so that they have this cushion if they ever need it, like if they ever ran into trouble. And if you were to bring that to them as the lender or the agent or both together, like, what an incredible value add to that consumer. And if you advise them on something like that and they end up losing their job and then they have the HELOC that gives them some flexibility, like they're gonna scream about you from a mountaintop forever because you actually made a difference. You actually added value to them.
Yeah. I'll just flag a couple of things. I would want to come your content. I mean, it's like content. You're getting in front of that with your clients. I want to help you talk to your clients about pulling cash out, maybe not a HELOC, but maybe to buy an investment property, or pulling cash out using cash, maybe pulling cash out to remodel in place, because if you're going to be ultimately listing that property, you might even be a good advisor of what they should and shouldn't do as it relates to improvements on their property. And I think it's really interesting. You start opening up this whole spigot, if you will, of I can really help you create some amazing content around things like cash out and equity that you can go to your clients with and help you play the long game. Right. And that's probably where we're going with this, is that you're a long game guy.
Absolutely. Plus, you make yourself so one-dimensional if all you do is I can list your house or nothing, or I can help you buy or nothing. Like if that's your only value to the marketplace, you're extremely limited on your business growth and how many people you can actually help. But if you then bring in these other options that most agents don't ever think about ever, which is a mistake, you become so much more valuable to the marketplace. And those people that you help, even if you may talk them out of selling, but they're going to tell all their friends about you. You're going to get referrals from them for the next 20 years. So yeah, long game. Absolutely. Play the long game.
And this is where I feel like lenders too when you sit on this home equity thing, it's just like, there's so much optionality that in partnering with the real estate agent to go to their clients proactively, creating this type of content, there is so much amazing content to be created on that front. But let's switch gears a little bit right now. Just want to flag the second part real quick. And here's the comment. Love to hear your reaction. I think I know where you're going to go with this, but I've been in the real estate industry a long time, and it's interesting. People will complain is like going, oh man, we're 30% off of our highs. It's like, well, guess what? It's a 30-year average, like 5 million units a year. So you're at 4 million units. Yeah, you're 25% off of your average, but guess what? It's still 4 million units a year. Someone's going to close those deals, right? When you look at Joel's graph here, it's like, oh, it's just modest increase. How do you process on that? Does that mean anything to you?
I just keep thinking of how many agents I talk to on a regular basis who use high interest rates, weak economic data, whatever, headlines as an excuse, and not take action and actually do the stuff that's actually going to grow their business and make an impact on the people who will grow their business. And I see it all the time. It's like, well, interest rates are high, so, of course I underperformed this year. Well, that's weird, because I just talked to Megan in Florida and she just tripled her sales this year with the same interest rates that you've got. So it's very easy to see, to blame some outside force for why you're not performing, why you're not doing what you're supposed to, why you're not getting the results. And I think that that's a dangerous game to play. And I think it's weak.
Well, I mean, if I could draw a lending example, I mean, I think, I know we're not going to focus on refis a whole lot, but if you look at the amount of refinance activity we got in September and October, when rates went down to about 6.25%, I think on average, the 30-year fix was down to that level. I mean, that wasn't a low rate by any means, right? I mean, you we're still talking about people who have rates that are in the 3% range or even lower from 2020 through 21. And the question we got is, well, why were people refinancing? Because, the lenders who worked with those borrowers were in touch with them. They knew that these borrowers got a loan over the last few years that maybe was 6 or 7.5% even. And they knew the opportunities were there. Even with rates in the low sixes, that was enough for the borrower to say, hey, you know what? Like, that's going to save me, I don't know, a couple $100 a month. And that's big, right? And then rate is one thing, loan amount is the other. As home prices have gone up, people have borrowed more. So they have larger loan sizes. And I know Dustin doesn't like BIPs, but if you have a 50 BIP savings in your mortgage rate, that matters for someone with an $800,000 loan, right? Versus someone with a $200,000 loan. So,
right.
So in this case, the basis points or the BIPs matter. for some of these borrowers. So I think that sort of that active, not participation, but sort of that active contact, right? Like that really matters a lot, both I think to the real estate agent and to borrowers too. And we're seeing that more on the purchase side. So to your point, even with the weaker economic outlook, there are opportunities out there for someone who might say, you know what, I think my job is in an okay place. I'm getting paid enough, right? I have home equity and it's time to move. And my situation is manageable. So, if you're working with someone like that, then absolutely the opportunities are there.
Yes.
I
Can I add to
love
that?
that. You saw what Dustin, you saw what he just did there. He said, what I basically heard you say, Joel, was, hey, Dustin, you should care about refis too. If thematically here, if you're playing long game, you care about all the things that help your clients build wealth through home ownership, right?
Agreed. But agents are not paying attention to it, which creates an opportunity for a lender
Yes.
to educate the agent on what's happening and where those opportunities arise. But here's the way not to do it. Don't just send an email to all of your agent partners and say, hey, great news. The 10 years down, whatever, and rates are down, whatever bips. And you just leave it at that. And then you're putting all the work on us to interpret what the hell that means.
Right.
Instead, give a tangible example of, okay, rates are down this much, which means if you have a $400,000 mortgage at this, and then you refinance down to this, it's going to save you $250 a month, for example.
Yep.
Give tangible examples, because then we can see it and be like, wait, that's amazing. I'm going to go tell everybody about that. But if you put the work on us to interpret your BIP speak, then most of us aren't going to do it. We're just going to be like, okay, cool. I don't know what that means. On to the next email.
Well, this is my perfect opportunity. I don't like doing this, but shameless plug for Homebot. That's why we built Homebot, was so that lenders and agents can work together. So it wasn't just some generalized stuff. It actually gave every single one of your clients exacting numbers around how they save money and how they can build wealth. But anyway, I'm not gonna lean into that too much. Let's keep this going. Next slide, please. So let's talk about employment. Joel, what is this slide all about?
This is really just a look at where the industry has gone in terms of headcount. So we use a few different measures to do it, just looking at different data sources to try to see if the story jives, right? And really with the drop in volume that we saw between 2021 and 22, because rates doubled, you also saw a big pullback in lender capacity for obvious reasons, because a lot of the originations went away. And so lenders just couldn't afford to maintain that scale that they had built up for 2020 and 21, which were record origination years. So that explains the drop. But I think
But Joel,
really
let me ask you a question about that, Joel.
Yeah, go ahead.
But the measure on unemployment are you basically correlating that the employment is a one-to-one sort of predictor of the capacity to do loans?
It's very close. Yeah.
Okay.
So the definitely headcount matters for the lenders in terms of, your loan officers, right? Your back office, et cetera. But then also that kind of brings us, if you go from that drop that you see there to where we are now, things have leveled off. And obviously some of that is because a lot of this right sizing has been completed. Lenders are learning how to be more efficient with the lower head count. Sometimes you're forced to. And technology's been a big one, right? So we've been hearing lots of talk about both technology and AI specific applications over the last year or two. And so the question really is, are we at a point where lenders are staffed correctly? And so what I mean by that is, do you have enough to kind of weather the storm, if originations are low or lower, but then also have the capacity to ramp up if you do get refis, or maybe you get a stronger spring home buying season. So it's a story of having an efficient operation, but then also being able to leverage, I guess, technology or AI tools, depending on how you want to think about it, as needed, I guess. I don't want to say just because things pick up, you have to do more technology, because,
right,
there is some upfront work involved when you introduce new technology. So in a nutshell, I think we're at a place where hiring has leveled off, which is good news, I think. So that means people aren't cutting anymore. And again, lenders feel comfortable where they are. And so now I think it's more of a, looking for the opportunities, I guess, is how I'd put it.
it's interesting. The word that I've heard a lot on the sort of the lending tech side of things is like these refi booms. It's like almost, I hear a lot of people talk about, oh, advantage loan servicers because they're so tooled with their call centers to be able to go out and to just get those refis and slurp them up before retail even has an opportunity to mess with it. But I'm excited about AI because I see like these little mini refi booms is that AI in a lot of ways makes it accessible irrespective of scale, whether you're a broker, a single broker shop, whether you're a small shop, whether you're, wherever you are in that spectrum, that AI allows you to flex up, if you will. Digital labor is kind of a big story, a big narrative in AI in general. And I think it's really fascinating to see how that digital labor story in the horizontal AI space maps into lending that ultimately allows lenders to capture these mini refi bins really quick. Now, I'm always going to pressure test all of this talk about AMP and mortgage world and all this kind of jazz. Does this mean anything to you, Dustin? Does the fact that there are so many fewer LOs out there or total employment, does your phone or do our agent's phone ringing any less? Does this mean anything to you in terms of what's happening on the lending side with the employment?
Not a damn thing. I apologize. I've been asleep for the last few minutes.
Yeah, no. I
No.
hear you.
But you woke me up when you said AI. So that was interesting. I mean, ultimately what the agent cares about, and all we really should care about in this context is, can you do the job? Can you provide a great service to the clients that we trust you with? Yes or no? Like, is your company, like, are your underwriters reasonable people, or do they nitpick everything and they work to, like, they start with a no and work towards a yes, or do they start as a yes and try to avoid a no? Like, that's what matters to agents. And so all of this honestly is just, yeah.
Well, that's fascinating though, because I think that if you pull the string on this a little bit and you're working with a lender and let's say it's cut down to bare bones and all of a sudden there's a little mini refi boom. And now all of a sudden they're doing refi over here and it's very manual and it's consuming their time. They don't really have so much time for you and your clients that way. And I'm not trying to get too stretchy with this, but I think that's a very real concern if I'm a lender and I'm trying to develop a relationship with guys like you, right? On the agent side, that I get a mini refi boom and I'm going to put you on hold for a little while. That's not a great way to build a durable relationship. So I think to the degree that staffing AI allows me as a lender to service the little mini booms in a very efficient way, basically it keeps my fingers off the keyboard, if you will, and gets me more focused on building personal relationships, not just with my clients, but with you.
Yeah, Ernie, I think that's a great point. I mean, I think two things you brought up. One is that purchase refi mix, right? If we're looking at an environment where the refis are opportunistic and they're not always at a sustained level, then you would think that there should be time to provide maybe better service for the purchase transactions, and especially because those tend to be more high touch. And so we're at a point where, maybe, the staffing isn't as low as it could be given the drop in volume. And that is, if you look at the numbers, that does line up. And what I mean by that is, if originations drop by 80%, hiring actually only came down about 40%. So it wasn't exactly one-to-one. I mean, it lined up, but again, lenders need bodies, right? So whether it's back office, whether it's LOs out front, there's this need to maintain a certain level of headcount to function properly. And so that's one. The second piece is, I think on the technology side, I think you really sort of hit that on the head, is just the fact that the tools shouldn't replace the relationship between the lender and the borrower, right? Like, the tool is there to help the lender have maybe a stronger relationship and actually do the in-person stuff. And they can let the technology handle the more rote, repetitive stuff in the background. Sorry,
So
stuff is a highly technical term in AI fields, I'm sure.
So this is where it gets real. And I think this is where we get to land the plane on this on a lot of different fronts. So Dustin, you brought up, and this thematically, I think is so powerful for lenders to hear, is that as a lender, if I want to do business with you, I need to bring my understanding of macro, my micro, my work, what I do as it relates to, refis, purchase, cash out, all that stuff. I need to bring it to the table with you in a way that helps you create more content specific for your clients, whether it's social media or individual use cases. And so I think that in general, what happens here and what we look at as an industry is that we see that as a lender, I'm doing my own marketing. And I think this is where things get a little weird. I do my own marketing. And Dustin, I know you do your own marketing. And by the way, we're both marketing to the same Hollies. And I'm talking to them about all the, the cash out or the purchase or affordability stuff and all this, rate buy downs and concessions and assumable. I'm doing all that, right? But then you're talking about some of it as well. And so the messaging is like getting, double barrel shotgun from two different people who really should be working together more closely. And so I think this is where me as Homebot, we see an incredible opportunity here, that this collaboration between a lender and an agent to create content. And I'm not talking about necessarily long form generic content. I'm talking about driving that content down to specific opportunities for specific clients so they can react to that and know that, oh my gosh, Ernie and Dustin are working together. They're telling me one story and they're collaborating. They're working together to solve our problems and to help me get set up for the next leg of my home ownership journey. I'm going to project that this is the new model that people should be leaning more heavily into. It's, if nothing else, people need less people blasting them with content and, more high quality. How does that sound to you, Dustin?
Yeah, I think that's right. I mean, so a few things can be right at the same time. Agents should be laser focused on their own marketing. A lender should be laser focused on their own marketing. Where there's a huge opportunity is where you can do it together. And so I've said this for a while. I think Homebot is one of it's such a sleeper lead gen tool, because a lender and an agent can team up with that same client and just get them on a super helpful monthly digest that they're going to open 100% of the time. I open mine 100% of the time. And they get information about refi, they get information about insurance and all this other stuff. And we don't have to bug them. Like, how nice is it that we could still nurture our clients, but not have to bug them? Like, it's self-led. That's incredible, because look, very few people like to go to the car dealership and you just get hounded right away. How can I help you? What can I help you find? It's like, I'm just freaking looking. Just let me look around and poke around myself, please. I think that's how most people are these days. And so this tool, I think, is great because it lets people poke around, click on links, dive into research, dive into data, or at a minimum, just track their monthly home value all on their own. And it's branding you as the agent. It's branding you as the lender. You can brand your insurance agent as well. So that's a huge opportunity. But one thing that I want to say that it's an add-on to earlier. If you're a lender trying to win an agent's partnership, one of the best things you can do, the most powerful thing you can do, instead of you going to the agent saying, hey, bring me deals, is you bring the agent deals. I think lenders need to get really good at marketing themselves so that they become a source of their own business. So then you can go to any agent in town, any team in town, and be like, hey, I want you to try us out. Here's 2 buyers. They're pre-approved, ready to go. Here's 2 buyers. And you, as the lender, give the agent the client instead of just going with, your hands open saying, give.
But that's, here's what I have to say about that. It's like, that's the unicorn, right? And that's also where I hear lenders get so in their head about what you just said to do, because what they're trying to do, they know that they should be doing what you're saying. And they know that you want us to give you leads, but they get scared because at some point the subject matter starts to tread on your subject matter. And then there's this fear, I think, that you are going to get pissed off at me if I start talking too much about inventory, housing inventory, because that's your swim lane, right? And I'm just saying, I hear this so much where it's like, lenders want to do both, but then when it comes down to it, they're like going, 70% of my business comes from the realtor. I'd rather maybe just shrink away from, getting too aggressive with marketing because it's just going to get into their swim lane too much.
Yeah, I think if a lender has that story floating around their head, it's total BS. It's a value add to the agent if you are doing all the marketing stuff on all the topics, doing your own thing, attracting your own clients, building your own brand. That's good for the agent that you're partnered with in many ways, not just lead flow, but just having like a recognizable, trusted lender with a brand. Like that's a big deal too.
Yeah.
So I've been saying this for years to lenders. I'm like, stop thinking of yourself as a lender who's like, you do like your side of the industry is this and the agent side of the industry is this. And they don't overlap. It all overlaps. We have the same consumer. Our clients are the same people with the same goals. So who made the rule that if you're a lender, you can only talk about mortgage related topics on social media? That's insane. Talk about whatever is going to be helpful to your client. Because again, in marketing, you have to know who you're marketing to and then create stuff for them that's helpful to them. And if you just stick with mortgage related stuff, most people don't want to hear that unless they're in a very thin.
I need you to make I need you to do a video on this, post it, and I'll like it as many times as I can like it. And I think this is such a powerful message for lenders to understand is that they have, by the way, and even if it wasn't BS, right? That at some point in history that this was a real thing, right? Or situationally, some agents got mad at lenders for crossing over too much.
Mm-hmm.
When you've got a Rocket Redfin, Mr. Cooper situation going on where you are seeing, or Zillow and Zillow Home Loans, where you are seeing the big guys consolidate all aspects of the deal and all aspects of the content, you better get over that BS pretty quickly because they're doing it. They're consolidating. And I think this is where, if you hit the slide here, this is where, again, I want to plug Homebot on this because this is where we dabbled in this for a long time and we told a story on this, but I don't think our technology supported it the way it does just recently, the way we really opened up the aperture to allow like infinite co-branding, if you will, that doesn't cost people an arm and a leg. It doesn't cost anything at all, actually. And so the point of it is, and this slide right here is that this is where you don't have to be Rocket Redfin Cooper. You don't have to be you could be one lender, one agent, and be able to collaborate with one experience that does these things with regards to content for your clients and your prospects. And so I Joel, I got to ask the question because I know this is not economics, right? But I'm just curious, do you have any reaction to this or thoughts about sort of the motion here? Obviously, it's happening at a big industry scale right now, the consolidation, because there's margin compression and stuff that's going on. So that people are big companies are getting bigger. Do you have a reaction to this at that scale or at the micro scale of just individual practitioners?
Yeah, I think this is important right now, very relevant, very important because, we are at a time where it isn't just about a sole sort of purchase transaction. There's so many other things that kind of fit in here. And Dustin earlier brought up the impact of taxes and insurance. And now we're seeing insurance costs, insurance availability, even in many states that are posing a challenge to someone who is already owning, right? In addition to people who are looking to buy. And so, having sort of this combination, I guess, of different experts in the room is really important right now where, because again, it's not just sort of a one-to-one thing. It's having the I guess services, sorry if I'm using the wrong word, but just having the support services, which are no longer support, right? They're more like critical services to kind of help the transaction and help the path to homeownership and sustainable homeownership. So I think, I think it's very timely and very relevant.
It's interesting. What used to be sort of like these transaction pipelines that could run pretty independently of each other, right? don't run very independently of each other anymore. The real estate agent does depend on the lender being as good as they've ever been with the process. Now, I added in this slide here, there's actually another player who's not represented on this call today, but the insurance agent. The insurance agent is like, this is somebody where it's like insurance. It used to be just a very basic thing, like the insurance. You just, make a phone call, get a declaration page. Let's flip the screen right here, because I think it's really interesting in terms of, with all the stuff that's going on. I'm going to give a shout out to Neil Dingra from our very first podcast of this series. And he talked about how there's this huge corpus of buyers out there that are in sort of what if mode. And so everything that we've talked about today, everything that we've talked about, whether it's affordability and all the different affordability, it's like, what if, what if, what if? Now, I get it. ChatGPT can do a lot of what if stuff, but you really pressing through, these are like complicated things that are multi-domain issues, where having the lending professional, the real estate professional, and let's say the insurance professional collaborating really address this corpus of buyers that are in should I. I think that the right terminology he used was the should I. There's so many people out there, should I? And I think that, again, bringing this and landing this today as it relates to having the professionals collaborating to address big swaths of their clients and prospects, to address and help them answer the question, should I, is as relevant as it's ever been, because you've got all these weird things that are happening. Oh, interest rates are doing this. Stagflation might do this. Inventory is doing this. All these things going on. The professionals need to get together, collaborate together to give their clients a very clear sort of picture of should I, because it's not always yes, and it's not always no. It's super nuanced. But I landed on this last slide here because I think that insurance really demonstrates why it's so important to bring in the different players and bring in even the insurance agent in. You gave us a great stat here, Joel. The average insurance payment in the U.S. is up 69% since 2019, and it's up 11%. The thing that is so profound that came up in one of our previous calls that I'd love for our listeners to hear this is that just because you solve the affordability issue for your customer to buy the house doesn't mean that they will continue to be able to afford that house in the future, whether it's equity going up and their property taxes up, whether it's the insurance crisis that's happening because of global warming or whatever it is. Just because they can afford it today doesn't mean they're going to be able to afford it tomorrow. And Dustin, this kind of goes back to some of the things you're talking about. Again, it's how are you anticipating tomorrow for them? Does this resonate with you guys in terms of another opportunity to pull another professional into the story, if you will?
1,000%. And this is better than just like getting together with your insurance agent or like, let's do a live video together. Like those never really go well. So the affordability, like you said, Ernie, I don't think I've ever heard a real estate professional publicly talk about affordability being an ongoing concern. It's always, can they afford the house at the time of purchase? And then once the deal's closed, oh, cool. Best of luck. But what if we set those clients up for success by saying, hey, over the next 3, 4, 5 years, as home prices go up, insurance may go up, property taxes will go up. You need a team behind you that can guide you on keeping it more affordable so that it doesn't just get out of control. And pretty soon, 4 years later, you can't afford the house anymore, even though you could when you first bought it. So yeah. And this concept of a team, I think is gold. If you as a consumer, don't think of yourself as an agent or a lender or whatever. Think of yourself as a consumer of things. Would you rather have a team supporting you in whatever you're trying to do, or do you have a bunch of solo people? Right. I'd rather have a dialed in team that makes me feel better, that I'm covered on all these different points. So having your team of insurance agent, lender, agent, all doing some marketing together lightly, in a very low touch way, or sorry, low impact way, like I think is brilliant. And so it's refreshing to hear insurance even being talked about at all in this context, because I just don't hear it.
It's the elephant in the room right now, right? It's not just about staying affordable, but, and this is kind of on this slide, I said, I think as an industry, insurance used to always be the perfunctory part of the process, right? It just sort of happened, right? You found your house, you get the lender to do their job, you get the real estate agent to do their job. And it's like, and at some point it's like, hey, get us a new declaration page and insurance is all cool. And now there are deals that are blowing up at the finish line because insurance wasn't contemplated at the point of search, where it says, I can afford this home, but I don't know that I don't know what I know that the insurance payments can blow up your pity approval. And that's not happening until the finish line. So I think not only could insurance be brought way to the front of the process, but then after the close, it's an ongoing thing. And I think that's a really fun part of talking to you guys over the last couple of weeks and just how this whole insurance thing came out. Cause I think it just so perfectly illustrates how important it is not only to collaborate, but to understand how you're using content to do right by your clients. If you want to be a wealth advisor, you have to be in the saddle beyond the close. So I want to thank both of you guys so much. For our listeners out there, I wish we had B-roll. There's so much stuff that we have unpacked on these threads, but Joel, thank you so much. Dustin, thank you so much. I think hopefully our listeners took something away from this that'll help them go crush it in 2026 and not just sitting back, waiting for the business to come to them, giving them ways to go out there and get the business. I want to draw everybody's attention to this screen over here. Take a picture of the QR code. Obviously, we'd love for you to see Homebot and how they can do these things. But actually, what I'd really love for you to do is to follow Dustin, connect with Joel. These are, obviously great thought leaders in our space that you should stay connected to. Joel, thank you. Dustin, thank you so much, buddy. Really appreciate you guys.
Had a blast.
Thanks for the conversation.
Yeah.
Awesome. Good stuff. Thanks everyone so much for showing up today. You guys have a great one.